Welcome back to another weekly episode. So, the first thing I'll cover up is breadth in sectors, second is global markets and the specific problem for India, and the third section would be opportunity in select pockets. So, before I start this video, let me tell you nothing that I speak should be taken as trading and investment advice. You should consult your registered investment advisor for the same. So, in a snapshot, if you see what has happened in the market, now in Nifty total market space, which is 750 stocks, 44% are above 50 DMA and 50% are above 200 DMA. I would also give you the tone of this video. There is nothing wrong with the market. You just have to understand what is going on and then identify the opportunities specifically related to some pockets in the market. So, 10 sessions back, about 65% stocks were above 50 DMA. Today, that number stands at 44%. Above 200 DMA, 60% stocks 10 sessions back. Today, that number is 50%. So, if you see more damage has happened here, which is precisely what it is, that damage is faster than it is deep. So it's not to say that nothing can go wrong in the future, but as of yesterday, when the market is closed, that is on Friday, the damage has been in a faster manner where more stocks have gone below 50 DMA but are relatively retaining their structure above 200 DMA. See, as it is, number of stocks above 200 DMA has been fluctuating between 39% to somewhere around 61%. So we're somewhere in the middle. Yes, when the price comes down, it does not look great, but structure wise and even breadth wise, things are still okay. You need to monitor because the weekly candles were not great, but still. Now, where the money is still working. So, pharma, despite of the news that came out, which by the way cannot happen, entire healthcare of United States would also get impacted. It is just some bit of tantrums that usually go around. So, microfinance, especially smaller banks, healthcare, hospitals, defense, NBFC, realty, IPO names, private bank. Yes, private banks are still doing well. The large cap private banks are not doing well. But if you dig deep and identify the smaller private sector banks, they're doing amazingly well. Auto sector is recently moving up. Again, the two-wheeler auto space, not necessarily the four-wheeler space. Consumption and new age consumption. So this has been a constant in the market. These are the set of sectors that are still showing leadership. Now, what is happening to sectors that were earlier doing well? Now, within that, if you see banks have taken a hit mainly because of large cap private sector banks. But again, I would maintain that the results of large cap private sector banks were not that negative. So you have to understand, and I'll explain that in the second section, that it's a culmination of disappointment. Yes, certainly there was some disappointment, but also with respect to what is happening in the world. I'll come to that in a bit. So metals, banks, you have to keep your eye on these because metals especially was a sector that was doing very well. It is just pulling back. Nothing is wrong. Same with engineering services and capital goods also. Again, this number that you see, this is 59% stocks are above 200 DMA in this sector. In banks, 50% stocks are still above 200 DMA. So this is how you need to identify banks, metals, and power. Power sector especially, pay attention to this. Now, what you need to completely avoid. See, IT telecom, digital, insurance, FMCG, cement, SME, rural, all these pockets are still struggling. With PSU Bank, the thing is that yes, 17% stocks are only above 200 DMA, but PSU Bank on a higher time frame chart is still in a beautiful structure. That is why I remain very optimistic about Bank Nifty, and if I turn out to be wrong, I'll definitely come out and admit. But I'm very bullish on the entire banking space, including large cap private sector banks. Of course, they are out of favor partly because of the results and whatever is going on, but also because of what is happening in the world. I'll come to that in a bit. So, in this particular slide, I want to highlight. So, this is the entire financial sector, but even in this, you will find varied degree of performance. For example, microfinance companies, NBFCs, and private sector bank, not the large cap ones, are doing very well, as opposed to financial services, insurance, and PSU bank, which is relatively struggling. So, that is why the bank gets a 50-50 kind of a score, if that is how I would like to put it, because that is how the financial services space is divided. Some are working very well, whereas some are working really poorly. If you're interested in private sector banks, you have to look at banks that are smaller in size and are coming out with fantastic numbers. Same with NBFCs, same with microfinance. Anything that you do in any sector, your focus only has to be in the small cap, mid cap, micro cap space. So the next section is about global markets and the problems for India. The first chart I'll pull up is S&P 500, a simple 50 DMA on the chart. You look at what S&P 500 has done since last week of May. It's relatively flat. It is just below 50 DMA, but this structure is constructive. It is not a negative structure per se. The next chart is of Nasdaq. Again, slow and smooth within a rising 50 DMA. Yes, it sits below 50 DMA, but this structure Some will call it a structure of distribution, but there is no valid breakdown yet. A breakdown would happen if Nasdaq moves below 28,000 with sharp volumes, leadership collapsing. Till then, you have to read this as a positive structure. The next chart is of KOSPI index. Again, this index is down 25%, 9,200 to 6,600. That is more than 25%. Why this is important, I'll come. And this is the global AI and technology ETF. Again, what do you see? Massive deviation away from 50 DMA and now pull back just below 50 DMA. Why this is a problem for India? This is a problem for India because India is lacking on two fronts. And this is not going to change so soon. The first is the earnings gap. If you look at the median projection of S&P 500, not just the tech sector, S&P 500 companies, the median growth projection is 18 to 22% for this particular quarter. For Indian large cap companies, it is barely 9 to 11%. So there is a lot of earnings gap between the large cap, the mid to large cap companies in our stock market, where majority of indices are designed around those. That is why if you see the Nifty 50, Nifty 100, Nifty 200s of the world are just not working. The second is the theme gap. The theme gap means AI is a massive theme in the market, global stock market that is, and India has almost nothing in that. And that is also one of the reasons why Indian stock market at present is not getting that much attention. So earlier, that is about a month back when Indian market was still stable, it is still stable. It is just that it's not doing anything great. People are getting bored. To be very fair, nothing is happening at the global level also, if you look at it. Global markets are also highly stagnant. But what has now happened is that global markets have corrected 10 to 22%. And these pockets, the AI semiconductor stocks, which are down 25-30%, have now again started to look attractive. Now, if you ask yourself, if you are a foreign institutional investor, will you come to a country like India where there is no AI theme in large cap companies per se, or will you go back to these pockets which have actually corrected 10 to 28% or 30%? This is where the major problem is, and that is why I feel there won't be any major allocation in terms of fund flows that will be coming towards India. Partly, we have also shot ourselves in the foot. Our policies need correction. If FPI money is not desired, then FDI money should be welcomed in this country. We desperately need it. So hopefully those changes will come. As market participants, that is what we can do. We can only hope for the best. So mid to large and large caps will keep struggling, which means periodically you may see some rally coming in Nifty or Nifty Bank or Nifty, some other broad-based indices, but it will be the small mid micro cap space that will continue to attract a lot of funds. Next, where is the opportunity in our market, in which select pockets? And again, I'll pull out some charts. You need to understand this. The first is Nifty micro cap 250, small cap 250, and mid cap 150. This is where the selective bull market is playing out in the market. And if this is true that FIIs are not going to return to India so soon, it is also true that the retail domestic money is not going to go away anytime soon. Yes, SIP and fund flow will dwindle with cycles. What do I mean by this? Whenever the market falls a lot, people will be a little bit scared. But since COVID, retail investors are systematically putting money into the market. Why you don't see this? You don't see this because on social media, generally you are only reading about options selling, BTST, and those kind of rubbish things that go along. But if you look at the AMFI data, if you look at the fund houses, if you look at the private companies that are into getting money from HNIs, family offices, just look at the amount of money that is coming in. That is why the SMID space will continue to get a lot of support in the market, and this is where the bull market currently is playing out. So if you look at the chart of microcap 250, what do you see? This is a beautiful rising 50 DMA. Microcap has just touched this. All right, very similar to the S&P 500 chart. It is just that it is playing out in microcap and small caps, not in large cap. The next chart is again Nifty small cap 250. Today it has just touched 50 DMA. Again, a beautiful structure, higher high, higher low structure. The next chart is Nifty mid cap 150. This is a little bit volatile, but again, the trend is clearly up. It keeps touching the 50 DMA. Do you think at this particular point news flow would be great? It's not. Even at this point, it is not. That is why you need to take leap of faith. If something is working, it will continue to work until and unless you see massive selling on the downside, your stock hitting stop losses and those kind of things, and have a little medium term view in the market, guys. Do not do the mistake of listening to too much of short term commentary, because if you look at the regular news flow that goes around, let's say the last 7-10 days, I also feel a bit sad for anchors because they are not able to make up their mind whether they are bullish or bearish, because they are trying to time every top and bottom in the market. That is not what stock market is. Stock market can be two things for you: a wealth creation machine or a gambling machine. Why stock market does not work for majority of people? Because people consider it as an ATM and a gambling machine. If you consider stock market as an ATM and a gambling machine, you're only going to get debit. If you consider stock market as a wealth machine and invest periodically and systematically, you're only going to get credit in your account. This is how it is. And this is now the chart of Nifty 500. You look at how different these charts are. Look at this chart and now look at Nifty 500 chart. It's not even able to take out the 26 highs, 25 highs. This tells you that the problem in the market is that as you start broadening out, Nifty 500 has a relatively larger market cap companies. Whenever you're climbing that market cap ladder, the performance keeps going down. In the SMID space, there are not many, that is foreign institutional investors. So that is why our local money, domestic investors, they are supporting that part of the market, and that is what is going to play out. So there are three things here. Number one, structure. Where is the structure? Always ask this. The structure is higher high, higher low, rising relative strength. That structure currently exists only in the small mid micro cap space. I don't want to talk about SMEs because I don't understand that pocket, so that's why I'll just refrain from talking about it, commenting about it. But the structure is in SMID space only. Where is relative strength? Again in the SMID space. Very rarely you will find that some mega large cap stock is doing exceptionally well. Now, just for understanding sake, this is again not a commentary on any of the stock names that I'm taking. You look at what HDFC Bank is doing, ICICI is doing, Axis is doing, SBI is doing, Reliance is doing, Infosys is doing, TCS is doing. All these have amazingly poor relative strength against Nifty 500. So how do you think a massive rally in Nifty or Nifty Bank can come about right away? With Nifty Bank, I will tell you, when last week result came out, the structure of Nifty Bank was just about getting there. And then you again saw this bout of selling. Partly, yes, it was due to result, but partly it is also because if HDFC Bank and ICICI Bank and Reliance are growing at, let's say, X, then the AI theme abroad is growing at 4x, 5x. So why would people not use any short-term rally in these pockets to sell, raise more cash and deploy money there? Plus, yes, as I said, our domestic policies have also not helped. So your mindset has to be to buy the dip. The problem is that I'll just pick up this particular example. In midcap 150, if you can go back and see what was the news flow in June first week, you would realize why it is so difficult to buy. And what was the news flow here? Roughly, if I would tell you, crude 70, crude 100. Just a rough kind of estimation I'm doing, but I hope you get the point. Every time that you start to see a lot of positive headlines, that is never a great time to buy. Sometimes it will work, but majority of time you will start to see retracement. So when the dip is currently playing out in the market, let's say today, you'll always find that the news flow is highly negative. Data points will always be concerning. You'll always keep hearing on television and social media, now this is the key for stock market. That is the key for stock market. The thing is that market is a machine that will digest almost every news flow and still over time head higher. The word uncertainty around the stock market, that is stock market. If you start worrying about every single data point that plays out on day-to-day basis, you will have nothing but paralysis in terms of over analysis. Don't do this to yourself. You need to see when the news flow is not great and when the structure is sound. So if I tell you the structure of small cap 250, micro cap 250, even mid cap 150, the structure is absolutely sound. News flow is not great. So now you need to decide whether you can nibble something here and use your stop losses to manage positions, or you will sit out and finally one day when market again starts gapping up, you will start buying to find out a couple of months down the line that all of your stocks have gone into the red. So you need to make up your mind where your bias is in the market. A word about our domestic institution investors, our retail investors. I don't know how many of you were in the market in 2010, 2011, 2013, because this phase in stock market seems very challenging. The kind of commentary also that you're getting from regular television anchors is that nothing is happening, those kind of things. But this is nothing new. This is that post-COVID one way kind of bull market that people have gotten used to. This phase that is currently going on is not even the third toughest phase in the last 20 years, let me tell you. The toughest phase in the last 20 years was between 2011 and 2013, where actually nothing was working. No large cap, no small cap, no mid cap. Every time a rally would come, 10% correction would come. The second tough phase was 2018 January to 2020 January. I'm not even taking COVID. Because in that phase, only some bit of large cap sectors were working. Mid cap and small caps, micro caps were absolutely butchered. 24 months. And yes, now you can say this is the third phase, but in between, I think there was 1 year, 2015 also, where nothing was working. So this would be the fourth toughest phase. It is just that I think more than 60% people have come in post COVID when one way kind of bull market was playing out. That is why they've gotten so used to seeing prices go higher. That and then plus with the advent of these podcasts and all these people who have made massive amount of money, moved out of India, and now they have nothing but ugly things to say about what is going on in our country in terms of whatever. So your wealth will be created in the small cap, mid cap segment only, irrespective of whoever is coming on podcast and telling you anything. The thing is about consistency, the thing is about discipline. And one thing I'll tell you what has happened. The retail investor of this country, the DII of this country has shifted India from a high beta emerging market to a low beta emerging market. Now, this is a number 0.56 that would be so amazing for any FII to see. If somehow the message keeps going on about currency stability, more policies in their favor, more being more proactive, then you will see why this number will become so great for India in coming quarters. Because this 0.56 within emerging market basket, India has now become a low beta market that is so diversified, gives you opportunities in so many sectors, plus is massively liquid. India being a low beta market, if someday the tide turns in favor of India, or let's say FIIs want to take exposure in some well diversified market, then they will look at the beta. So what I am doing, I'm sticking to small mid micro cap only. My hypothesis is that FIIs will not return so soon to our country. And the theme of DII and local institution investors, retail investors, SIP players, they will continue to support this mid space. And let me tell you one thing, there is also a point spoken about valuation that this pocket is becoming extremely expensive. It's not extremely expensive if you look at the recent results that have come out. Look at the growth in this segment, and you'll understand why market is also valuing these segment at this particular level. All right, so be positive. Uh, Always have a watch list ready whenever the market gets volatile. Don't link the structure with news flow, because if you continue doing that, then you'll never be able to buy whenever the dip comes around. No one knows what is going to happen next week or next 20 days, 30 days, but you have your stop losses, you have your risk management rules to not cause excessive damage to your account. All right. So take care, guys. Be safe.